Hello and welcome to Trading Mantras. Today we are going to explain most effective and powerful option buying strategy. Actually, many people say option selling is low risk and high reward, whereas option buying is high risk and low reward due to its premium decay. But many people don't know, even with option buying, you can make more trades profitable if you follow certain rules with proper discipline. We can avoid time decay as well premium depreciation. Okay, you can double your capital even easily within 1 or 2 months. If you could master this setup we are going to explain, practice this as much as you can. Do paper trade at least minimum 1 month and then only try to execute in live market. Being a beginner, don't just jump straight into live trading. Okay, first of all, always remember you came here to make money, not to do gambling. Okay, so you must have discipline to make money. Okay, watch the video till the end. If you skip the video, you don't understand anything, you will miss a lot of stuff. Okay, don't trade for just shake of joy, it will cost you loss all your money. If you are an experienced trader, then you can try this strategy with your designed risk management, in the sense proper position sizing and with defined stop loss and defined loss per day. If you don't decide your risk per day, then you can never make money, I'm sure, because lack of discipline, market will make you learn a lesson and will make you more humble. You must know how much loss you can bear in a day. You must know what is your risk appetite in a day. Then only you will be successful in trading. Before getting into the setup, you must know one thing. If price is rising, call side premiums will rise, right? If call side premium is 100 rupees here, if bank nifty is bullish, then call side premiums will rises like this, right? 100 will become 150 like this. If it is going upside, like 150 will become 200 like that, right? If bank nifty spot price is going down, then put side premiums will rise. Okay, that is the basic thing you all must know, right? Okay, there are 4 kinds of markets: trending market and volatile market and range bound market. Sometimes volatile to range bound also possible, sometimes sideways to choppy. Sideways market is nothing but a choppy market. Okay, these are the kind of markets you can see usually in bank nifty. You all know sideways market would be like this. It will be like this, right? If it is range bound, it will be like this. It goes ups and downs with volatility. Volatile market would be trending to volatility. It will make big moves upside and downside like this. Trending market would be like this. It makes higher highs, higher lows like this. If it is downtrend, it makes lower highs and lower lows. Okay, that is how the market behaves. In sideways markets, okay, in options buying, the premiums drops like this. If it is sideways market, the premiums will drop. Okay, means due to time decays, the premium depreciation possible. So this strategy only makes small losses if the market is sideways. Okay, if it is range bound to volatile, it can make small profits. If it is trending upside or downside, you can make very big profits. Even if it is volatile to range bound, you can make big profits. If market going up, you can book calls. If it is coming down, you can book puts. Like that you can play in the range bound to volatile market. If it is trending, you can keep on trailing your stop losses and you can maximize your profits. Okay, that is how you have to play. In the choppy market sideways, it happens very rare scenarios in bank nifty, so you will lose very less. Okay. Why we are making different option buying videos? You might have asked such question, because you see different people do have different abilities. As per their approaches, people do deal with differently, right? Not everybody can adapt a single setup and may not able to master it right way. Suppose if you like riding a bike, then other guy may love to drive a car. Some other may love to walk. Few guys, they may love ride a bike and drive a car, and even they love to walk. They do three things together with respect to the time as per their wishes. At the same way, as for the comfort and understanding, try to master the strategies you like and make money. Few skilled people can use different techniques at different times. It's their capacity, right? Let them learn and make use of it totally. Always show passion to learn every day if you are serious about making money in your life. We will try to deliver as much as knowledge in form of the video as possible, okay, in our channel. So keep on tuning us. Okay, let's see execution rules. Entry should be around 9:45 a.m. or 10:15 a.m. You can take entry between these intervals. If you are an aggressive trader and can manage risks, then you can take entry at 9:40 a.m. Otherwise, wait till 10:15 a.m. Okay. At those time intervals, either 9:45 or 10:15, observe what is Bank Nifty spot price. Spot price of Bank Nifty, either 9:45 a.m. or 10:15 a.m. You must observe what is the Bank Nifty spot price. Once you knew the spot price, then add 400 to the spot price and add -400 to the spot price for Friday and Monday. Remember these things, listen carefully, okay? You add 400 to that spot price plus 400 and add -400 to that particular spot price for Friday and Monday on particular weekly expiry, on the same weekly expiry. Okay. What about remaining days? We have told for Friday and Monday add 400 upside and -400 to downside. Then remaining 3 days, Tuesday, Wednesday, Thursday, what should we do? For Tuesday and Wednesday, we add +300 to Bank Nifty spot price and -300 to Bank Nifty spot price. This is for call side and this is for put side. For Tuesday and Wednesday on the same expiry, weekly expiry. For Friday and Monday also same weekly expiry, but we add +400 -400, +400 and call side -400 and put side. But here on Tuesday and Wednesday we add +300 and call side and -300 and put side and same weekly expiry. Okay, but what about Thursday? Let's have a look. Thursday also we add +400 upside, call side, +400 to spot price and -400 to put side, CE side. Okay, and This is put side, PE side. We add plus 400 to call side, I mean to the spot price, plus 400 to the spot price for Thursday. Because on Thursdays, due to expiry, we can see premium depreciation due to time decay. There is no intrinsic value, so premiums turns into zeros. So we don't take on the same weekly expiry day because we are doing option buying to avoid premium depreciation. Okay, due to time decay, premium drops, right? So we take next weekly expiry contract. Okay, we select the next weekly expiry strikes for call side and put side, and we add 400 to call side and minus 400 to put side. Okay, this is how we have to trade. First of all, what should we add for Friday and Monday? We must add plus 400 to the plus 400 minus 400 call side and put side to the spot price. Tuesday and Wednesday we must add plus 300 and minus 300 to the spot price for Tuesday and Wednesday. But on the same weekly expiry for those 4 days. But only Thursday we take the next weekly expiry strike prices. Okay, to avoid premium decays. Okay, usually on most of the times the premiums will turn zero and weekly expiries, right? So we don't take on the same weekly contract on the Thursdays. So we take next week contract for the Thursday trading execution. Okay, keep these points noted. If you understand these points, then only you can execute trades by your own. If you don't understand, you can't even trade. You mean even you trade, you lost the money. Don't do that. Try to understand what are the logics I am explaining you. Okay, these are simple maths and simple explanation, but some slight changes you have to understand. Why I am changing strike price, you will understand by experience. Okay, why I am changing the for plus 400 minus 400 respect to the days. So you understand by time goes. So these are the first and foremost important rules for execution. You must remember. Here we are doing this trade with simple math numbers with logics, not a complex setup. Just write down the things I am teaching you and follow them step by step to master this setup. Once you master this setup, you will definitely make very good returns, I'm sure, on your investment. Okay, let's get into next step. Suppose Bank Nifty spot price is at 36,000. You can see our Bank Nifty 36,000. And then what we must do next? As we explained before, Friday to Monday, we add plus 400 upside and minus 400 to downside. Means we add plus 400 so, and the downside minus 400 means minus 400 here, plus 400 should be around this level. Okay, we add Friday to Monday. But for Tuesday and Wednesday, we add 300 plus 300 to upside. This is Tuesday to Wednesday. This is downside also, Tuesday to Wednesday. This is Thursday to, sorry, not Thursday. This is Friday to Monday. Friday and Monday. We add 400 upside and downside Monday. Because of high premiums we get due to high volatility, we add 400 strikes away from this spot price. We take 400 strikes away calls and 400 strikes below strikes for Friday and Monday. This is how Monday, this is Monday. Okay, this is 300 minus means 35,700. It would be around upside 36,300. This is plus, this is minus, this is plus 300. Okay, this is for on the same weekly expiry. Weekly expiry, same weekly expiry. Okay, if spot price is 36,000, then this is 36,000, then we add plus 400 upside for Monday to Friday and for call side, and minus 400 to downside, means 36,000 minus 400 means, which is 35,600. Upside 36,400. Okay, this is Friday to Monday only. For 2 days we add plus 400 upside and downside minus 400, which is 35,600 PE. Okay, it might be messy. Try to understand. Okay, try to listen the concept clearly. Concept is very important. Upside 36,400 CE. Okay, these are the strike prices we must select for Friday and Monday. If spot price is at 36,000, if spot prices changes by next day, you can add plus 400 to the particular day's strike spot price, plus 400 upside and minus 400 downside. Okay, you can't get the same spot price in the consecutive 2 days, so price varies both the days, so you changes. I am just giving some example. I am assuming 36,000 as a spot price and just explaining you. Okay, you can take plus 400 from the current spot price and minus 400 from the current spot price for the Friday and Monday. And Tuesday and Wednesday, what should you do? You must add plus 300 upside and minus 300 downside. Plus 300 upside in the sense 36,000 plus 300, 36,300 upside, and 36,000 minus 300 in the sense 35,700. This is 35,700 PE. You must take as a strike price on the current week expiry 36,300 CE as a strike price on the current week expiry. Listen, I am telling you current week for both scenarios. Okay, for these all 4 days you take only current week expiry only, but for Thursday only you take next week expiry. Okay, what should we do on Thursday? Let's check. For Thursday, we do select next week expiry contract with add plus 400 upside and minus 400 to downside spot price for CE and PE. Example, if it is current May first week expiry, then we select May second week expiry contract strike price for Thursday. Okay, suppose up to on Thursday, Bank Nifty spot price reached 35,500. Then we add plus 400 minus 400 to it and do trade on that day with next week expiry. Suppose 35,500. Let's see. Let's go to 35,500. On Thursday, if Bank Nifty reaches here, price won't be same on every day. Right? Changes day by day. Price is variable. Okay. If price reaches 35,500 on Thursday, okay, you add plus 400 upside in the sense 35,500 to 400, 35,900, which is the call you should take. 35,900 call you must take, and downside 35,100, which is downside. Okay, I'm just writing here. Okay, which is put. This is call. Okay, you take such a way, minus 400 downside plus 400 upside, but you take next week expiry due to premium depreciation. Next week expiry. Okay, due to expiry, premium melts very quickly, right? So we must select next week expiry only contract strike for Thursdays. Okay, as we all knew that on Thursday Bank Nifty and Nifty premiums probably turns 0 because time decodes proportional to premium depreciation because there is no intrinsic value. You understand? So let's go to entry timings. Entry timings. I gave you time interval to take entries as 9:45 a.m. or 10:15 a.m. Why I explained you to only aggressive traders to take entries at 9:45 a.m. because around 9:45 a.m. early morning volatility up down swings probably decelerates. That means slows down and market takes some direction. But sometimes volatility extends up to 9:45 to 10:15 a.m. Sometimes market volatility may end up with like 9:45 a.m. around, and it takes some direction like upside direction either like this or downside direction. Sometimes it extends to 10:15 a.m. That's why I recommended to take trades till 10:15 a.m. to be in safe side. If you are aggressive trader, if you are aggressive, then you can take trades around 9:45 itself. That's all up to you. Okay, that's your choice. If you are an experienced trader, if you are able to manage the risk, okay, if you can control the risk, if your appetite is like risk appetite is huge, then you can take risk around 9:45. Max times 9:45 also decelerates, but 10:15 is the best time to enter the trade. Okay. Let's discuss how to execute trades. Listen carefully. It's very, very important. Okay. Okay, before getting into that, let's check actually what happens around 9:15. Okay, on the previous charts, you can see here around what is the time here around? This is around 10:15, right? So it takes some direction here, right? Around 10:15, right? Around 10:15, 10:15, right? If you take an entry, it goes in favor of you. Okay, there is no depreciation usually. You will be on the profit side. Okay, let's check other charts. What is the time here? Around 10:15, it stops going down and it changes its direction. Almost it starts making some wicks around here 10:15. So you will be on the profit side only if you entered here around 10:15. Okay. Huge rally, you will make huge profits. So 2 consecutive dates, you will be in the profit if you enter at 10:15. If you enter at 9:15, it will be in some volatility. You might have waited for some volatility slowdown, and then 10:15 is the better time to enter if you want to be in the safe side. Here you can see it's almost sideways till 11:20, but 10:15 itself it takes some direction, right? It will be in the downside only. If you taken some put or something around 10:15, okay. If you put the limit order, you will be in the profit side only, downside. Okay. Let's check another chart. What is the time here around? If you enter even here with limit orders, buy side and put side, and the call side limit order will be taken, and you will shoot up to this one. If it is going like this in favor of you, then you can start trailing stop losses, okay, to avoid the risk. Okay. Here you can see 9:15, 9, 10, 10. This is 10:15 candle. See rejection candle. You see. That's how powerful 10:15 timing. You see, market is changing its direction or it's going in the same direction. Here also you see 10:15. It started going up. Okay, that's why I am suggesting you to take trades around 10:15. Okay, you understand why I am choosing here. You might lose something for one candle. Even it's not a it's not. It's in your control only. Okay. When you put with some limit order below this candle like this, okay, you will be in the call side in huge profits. Okay, if put side is if put side is turning negative, then you take an entry. I'll explain. I'm gonna explaining that. Okay, you will be in the huge profit only as per our logic. Here you see 10:15 around. It takes some direction. You see. Up to day high, you can make the good profit. Okay, that's how important 10:15 entry. You understand now why I'm recommended to take entries on 10:15 to be in the safe side. Okay, Okay, let's get into how to execute trades. Listen carefully. Okay. Step 1. We add plus 400 to Bank Nifty spot price, right? 36,000. So we select 36,400 call side CE strike price for Friday and Monday, right? Friday and Monday with same weekly expiry, on the same weekly expiry and Monday, which is upside 36,400 and downside 35,600 PE, you know, right? Friday and Monday for 36,000 spot price, which is for 36,000 spot price. We execute buy limit order by either 945 or 1015. Better you go with 1015 only. When I shown you on the charts, 1015 is the better entry. So you take entry 1015, okay, which is 36,400 CE strike price, okay. You understand? You are following what I am explaining. 36,400 CE premium, if it is 300, okay, around 1015, 36,400 CE premium is 300 rupees, which is high. Let's assume, okay, it may be the high for 36,400 CE strike at around 1015. Then you put limit order at 301, okay. On the other hand, you understand? I will explain again. Right. Just a moment. Okay. Friday, Monday, for example, either of that day, you add plus 300, right? 36,000. So 36,400, which is CE. Let's assume this current strike price is 300 at 10:15 AM. Okay, this is the high at 10:15 AM call side. Okay, so we put limit order at 301. If it is the high of that 10:15 AM time, we put the limit order at 301. That means if the price is breaking upside 10:15, okay, top side of the premium upside 300, then it executes your trade, okay, call side. On the other hand, which is 36,000 minus 400, in the sense 35,600, right? 35,600 PE. Let's say this premium also 300, okay, at 10:15. I'm just assuming it might be 20-30 rupees difference. It could be more or less, okay. We don't exactly, it can be slightly vary. 35,500 PE would be 300 rupees at 10:15 AM. So we put limit order at 301, okay, for Friday to Monday with same weekly expiry. This is also, we put limit order 301 for put side, and we put limit order for 301 for call side, okay, on the same expiry. We put same limit orders at the same time, okay, by 9:45. If you are an aggressive trader, 10:15 is better for safe traders. It's up to you, okay. You understand my point? 36,400 CE makes 300 high for 10:15 AM. 35,600 PE makes 300 high, premium high, which is high for the day high for 10:15 AM. Then we put limit order of 301 for CE and PE also. Both sides we put limit orders. It might be any value, but we just assuming if it is 300, if it is 300, call might be 310 or something. If it is 310, then you can put 311, which is a high breaking point. Next, if price is going up, then it should cross 300 levels, right? Then you put above that price, so you put 301 as a limit order. Okay, that's how you have to plan both sides as a limit orders. Okay, you understand this point, right? Let's get into the next step. Okay, if any one side buy order executed, if call side buy order executed, for example, if it executed 301, okay, let's assume price is going up, which is day high 300, you put limit order here, 301 got executed, CE side, okay, and you put another side PE order also 301, but this side executed, CE side executed, okay. I mean price and premium moving in favor of you, then hold your position as it's supporting your entry, okay. As it's executed CE, that means market is going up, then you can cancel PE. So that can cancel this PE side, because you all must know that if Bank Nifty is going upside, bullish, then call side premium increases, right? If Bank Nifty is going, we explained in the earlier, and this is the basic one. If Bank Nifty is bullish, calls premiums will rise, right? And put premiums will drops, okay, or melts or depreciates, right? So if we call strike price, which is 36,400 CE premium, breaks 10:15 AM high, then that means Bank Nifty is going up, and then obviously put side premium drops, right? Put strike price, which is 35,600 PE, can't break the high, which is 300. You understand? If it is going up, that means put premiums will depreciate, so it can't break this high. Actually it's also going up, I'm just showing downside only, okay. You can assume like it is going up like this, I'm just showing downside, I'm just showing the same chart like this, okay, like imaginary method. Okay, you can assume that it's going up, like, but it can't able to cross the high, okay. Instead of that, the premium drops, okay. What to do if it's reversed? Okay, if it is going up in one direction in favor of you, then it's okay. What if it is reversed? What should we do? Here one point you must remember. Let me clear this. Suppose as we have taken call position 36,400 CE at 10:15, okay, and going up, then suddenly reversed, it's going like this, and put is coming down like this, for example, okay. This is the day high of put, and if Bank Nifty is going up like this, sorry, it is coming like this, Bank Nifty is going like this, for example, it reaches some 310, or I just stretched this line, you can assume it is reached some 320 or 340, and it might depreciate to some 240 or 210 like that, okay. If call is righteous and at 10:15 and it's going up, then suddenly reversed, and what to do now? Okay, if it is going up, then it's okay. If it is reversed, what to do? Whatever the position, put side 35,600, if it is going up, we cancel the put side position, right? Okay, if it is coming down, then you must retake the same position, re-enter with the same position. Whatever the position you cancel with the put side, you must take an entry with the same put side position with the limit order or with current market price, okay, to ride the market till evening. That is the main rule you have to remember. If it is going upside like this, CE side, we cancel put side position, right? If it is coming down, then we have to take the same put side position, you must execute this trade again, okay, to hedge this call side. Because if it is coming down, the call side premium starts melting, then if you took the put side position, it balances, right? You will be hedged. Okay, that's how you have to manage, and you can hold the trade till evening. Here we hedge the positions if the market not moving the same direction once our first order gets executed. Okay, if 36,400 position started turning negative, what should we do? What does that mean? 36,400 CE, which is CE, right? Suppose 1015 CE at 1015 at 300 price, which is high, and the put side 35,600 PA. At 1015, this is also at some 300. Okay, we placed both limit orders at 301 for both, and Bank Nifty started going up. So it breaks 300 and executes CE side. So we cancel put side order. We cancel. Okay, after some time 300 become 1045, let's assume, around 1045. Let's assume 300 may become 330. Upside it goes very slowly, but put side will come down very quickly. It melts around, as per my experience, I'm saying 25 to 30%. It melts very quickly. So it turns around some 240 to 200 to 210 levels. It depreciates around 1045. Suddenly, after 11 o'clock, whatever the premium it make 330, Bank Nifty started coming down. So it reaches quickly to 300 and started coming into negative, which is less than 300. CE turned into negative. Then what should we do? Here, whatever the premium already melted here in the PE side won't get recovered very easily. Even Bank Nifty fell because going up is very, very hard. So whatever the melted premium, we get into the discount price. If it is turned into the negative, so we enter PE at the same strike price with the discount premium price. So which is very, very safe, right? Very, very safe. So taking put side entry will be very, very small risky. As premium we get at discount price than before. So buy and hedge position. So whatever the we price now we get for the discount, so we buy and hedge this position. So put side entry will be very, very small risky. That's why we take position and hedge the position. Okay, you understand this point now. So what if put gets executed earlier and reversed? What should we do? How to hedge with CE? Okay, let's assume this is 35,600 PE. This is 36,400 CE. Okay. Okay. Initially, put gets executed as market coming down like this, and we cancelled the CE order. It went up to 320, 330 level, but whatever the CE gets depreciated due to time decay and low intrinsic value, and depreciated up to 25 to 30%. Usually it happens. So it falls up to 300 will turn 240 or 210. So if it is turning negative, means falling down 300, below 300, then we take call entry around 240 to 210 levels or 250 levels, which is huge discount for us. Whatever the strike we have cancelled here for the call, as put is going up, we cancel, we don't need to let it open. So we close this position. Once the prices started coming down for the put side, so we retake this position. We re-enter for the same strike price with a discount premium. Because so taking call side entry will be very small risky. as premiums we get at a discount than before. So we buy and hedge this position. Okay, you understand? This is how you have to manage this strategy to avoid the losses. Probably most of the times your trade will turn positive till evening because price won't stay at one concentrated area, right? Most of the times it moves either up or down in bank nifty around 200 to 3 points at least. So already hedged positions will be in the green max times. If it is the choppy market, then only you will be into the loss. If it's going in favor of you, in favor of your direction, then start trailing stop loss. If it is trending or volatile, if it is going up, keep on trailing your stop loss. If it suddenly reverses, then you can use your put position. That's how you can hedge. Okay, always keep on trailing your stop loss to maximize your profits. That's how you have to play with this strategy. You understand? I hope you understand this explanation. You get the clarity now. Important rules for this strategy: only one trade for day, one trade only per day, and capital would be 40k to 50k. Minimum capital you should have 40k to 50k. Okay, always plan your position sizing and risk management. Okay, if you are a beginner, better to take only one lot. Don't take more than one lot if you are a beginner. Practice at least 1 month minimum paper trading, then only go live. I don't recommend to just directly jump into the live trading if you are a beginner. Okay? If you are an experienced trader, you can plan however you want. Okay, monthly you can earn minimum 100% on your buying investment and more than that. Most of the times, if you follow the all rules strictly, you will definitely make more than 100%. Okay, most of the times if you follow the rules strictly. That's why I recommend you to do at least 1 month paper trading. Okay, trade only weekly expiry, Friday to Wednesday, but Thursday onwards next week expiry. Okay, don't forget it. On Thursday you should take next week expiry. Friday to Wednesday you should take current week expiry. And Friday and Monday you should add plus 400 upside and downside minus 400. Plus 400 in the sense call side plus 400 from the current spot price and downside put side minus 400 to the current spot price. And Tuesday and Wednesday you should add plus 300 to spot price upside for CE and downside minus 300 for PE from the spot price on current expiry only. For Thursday you should add plus 400 upside for CE and minus 400 downside with next week expiry contract. Okay, this setup for option buying only. Anybody can make money using this setup. Okay, even you are a beginner, experienced trader, anybody can make money by using this setup. As per my experience, optimized stop loss is 35% of your premium. Reward you can plan around 50%. Like if you put like 35% stop loss on the premium, this stop loss is on the premium, not on the spot prices. Okay, you can calculate 35% of the premium your stop loss. Okay, and reward you can plan 50% minimum, and you can start trailing your stop loss. Sometimes it can give 100% reward. Sometimes it can give more than 100%, 200%, 250%. Who knows? Anything it can give. You just keep on trailing your stop loss if it is trending like that. Okay, if it is huge bullish trend, you can start a trailing. Always keep on trailing your stop loss, or else it can reverse and it can take your stop loss even. Okay, if you entered at like something like 300, then if it is reached 450, then it would be around 50% of return, right? It reaches usually, probably it reaches. If you take 300, if it is upside bullish, then usually it reaches easily 450 levels. It can be more than, sometimes it can move to 600 also, which is 100% returns. Okay, if you get like some 600 premiums, you can start kept on shifting your stop loss upside. Okay, suppose if you buy 36400 CE bar at 300, 36,400 CE bar at 300, then your stop loss would be at 195, which is 35%. can put stop loss at which is 105 points stop loss. Okay, suppose if you buy 35,600 PE at 300 rupees premium, your stop loss at same 195, which is 35% stop loss, 105 points risk. So both sides combined premium would be around 210. If you loss, both sides will be 210. You won't lose more than 210. Hit your stop loss. If it is 300 rupees only, if it is 500 or 600 of the premium, sometimes premiums are very high. Usually 352. If the 400 strikes away, the premiums would be around 350, 400 like that. Okay, if they are high, more than 300, 400, then you can calculate based on 35% of the 35% in the premium, not on the spot price. Okay, it is 35% on the premium only. You can calculate based on that. In case if it has to be hedged, then total premium would be around 210, 500, both sides. Suppose if it is hedged position, it goes up to sometimes 300 goes up to, by melting down, 240 to 210, right? So this also some 100 rupees in 35% in the sense it would be around something like total 200 or 190 or something like that, 200, 190 or 205, something like that, or 1 lot on both sides. If you are a beginner, just do trade with only 1 lot only. Okay, that's all guys. This is about option buying strategy. If you are a beginner, at least you do paper trade for 1 month and only enter into the live trading. If you are an experienced trader, you can try all your ways. However, you can minimize your risk and you can enhance your profits. Well, that's all your wish. Okay, thank you guys. Happy trading. If you like the video, like, share and comment, and please share with your friends also, and hit the bell icon for the latest updates. Subscribe to our channel. Thank you guys. Happy trading. Have a nice day.